morning, traders. This is going to be a short video and explaining how to handle these earnings report. It is really something that the outcome is unknown. I mean, like in everything in the market, the outcome will always be unknown, but the earnings report can really basically be a double-edged sword in the sense that, you can study the company as much as you can basically go through all the different analyst reports, buy recommendation, sell recommendation, fundamental analysis and estimates for the earnings to be coming. It is difficult to put your finger on exactly what's going to happen on that very day. When, in the sense, it's a bit of a roulette kind of like situation where you can bet everything on the black, but then the red will come out and vice versa. So I don't like to play earnings report. The one way that I've found usually in the past, play via the options market. When you trade the options, and by the way, when I mean trading the options, for me, it's going to be most of the time big long premium. From the onset of the trade, I know where my risk lies. I know exactly how much I pay as a premium. I know exactly basically how much I stand to lose if I lose the whole full premium. And that helps me to basically carry that trade over through that earnings report overnight, where we're going to see that massive move. This has been definitely the case for the recent earnings that we've seen, especially in the case of Amazon, PayPal, Facebook has been like absolutely crazy, AMD, UPS. This earnings cycle, and we're still in the middle of it, has been quite intense with a lot of opportunities. I would like to illustrate for you guys the importance of knowing when to pull the trigger, the importance of basically having a rationale behind every single trade that we will undertake, and at the same time, basically when everything lines up in terms of your game plan, in terms of basically timing, in terms of risk management, in terms of money management, in terms of risk and reward opportunity that you can find in any particular situation, then you will make sensible decision. You will have a trade that worst case scenario will lose you money, but still within the constraints of your risk management. But more importantly, you will have an intelligent plan. You won't basically taking like that trade on the back of just kind of FOMO or thinking, I feel that, or I've got the feeling that. No, the feeling is not good. Basically, you have to have a rational and a deep analysis behind every single trade. So let me take you through some of these trades that I've done this week. I like everything that's visual myself, and I'm sure like a lot of people like visual. It kind of like basically right in front of your eyes. You understand. You can express yourself. You can understand things a lot quicker in a visual way. So let me take you through some of these trades.
So right now you've got a picture snapshot of the trade that I've taken in Gilead. And what happened is basically the rationale for the trade was, let's turn to my TC2000 now, okay? So, all right, that is Gilead. So that's a biotech pharmaceutical company, quite famous. And just basically understanding the concept, the kind of the context, okay? They reported not last night, the day before last night, so that was the night of Tuesday to Wednesday. And that's on the night of Tuesday to Wednesday. Let's just basically relook at the, what we've done on the market. That's basically that day, on the Q. We were hitting this area of resistance. I was telling you about. On the S&P, same thing. They were hitting basically those levels that were important resistance, horizontal resistance, but also the convergence of my downtrending EMAs. That was the first thing that I was eyeing. Second thing was that Gilead had been really kind of like revolving like just below the EMA 200, not being able to go over that. And at the same time, we had like these big trending down EMAs that are converging down, and the market was basically here. So that's when we were on Tuesday on the close. Okay, Tuesday from the night from Tuesday to Wednesday, Gilead was supposed to report their earnings, and that was basically the sort of rationale of my trade. I don't like to trade earnings report. I think usually it's like it's like a flip of a coin kind of, because you never really know what's going to come out. Those companies, they might have come up with a big surprise report, and this market can go up big time or can go down big time. So that's why usually I've always told you, when you have a position ahead of the earnings report, if you have a position in stocks just before the earnings report, try to minimize the position. Try to basically downsize the position to a manageable position, because you never know what could, it could go right in your direction, in the right direction for the side of your trade, or it might not play out at all and go against you, and there's nothing you can do. That's why that's this sort of like very binary situations. They can be a bit strange. And that's basically where the options come up handy. Because if I was basically to trade that sort of idea, and the idea was what, that Gilead has had issues. We know that they've had issues, and they've also had like quite a few different lawsuits and things like that. So the idea was that we are in a market which is basically trending down. We are in this big area which has been holding the market for the past week and a half, and we are on the brink of basically getting a report. If the report was really exceptional, and obviously yes, the market basically go back up, but my idea was that still we had this big downtrend convergence that will cap the market on the way up, and this area of like around 70 would basically probably hold. That would have been from what we had closed, a market move of about 2 to 3%. But I think that the market would have hold, probably that area of 70, 71. I think would have hold. On the other end, if the market basically came up with a report that was really not as expecting and a lot worse than expected, then the idea was that this asymmetrical trade and risk and reward, whereby where we are now around 68.5, 69, I had maybe $1 to $2, $1.50 upside, and downside, because the idea was to go short. And on the other end, my first levels of support that I could see on my chart were really in the area of like 64. You see the Duncan that we had hit recently here, 64 and 65, this area as well. Let me just show you that these Duncans, as you see, this lateralization of the market that we've had. So this was the level that was important for me. Okay. So 65, 64 was the area that I was looking. If the market had some kind of bad earnings and the market was going to dive, help with the general market, to help for the fact that S&P and Nasdaq were hitting the big resistance area in a downtrend, and same thing for Gilead, which led me to take the trade that I'll just showing you about, which was, so again, the rationale of the trade, we're hitting heavy daily resistance after a big bounce, which was not a big bounce, it was more like a renting market really before the earnings report. Good risk reward that I was telling you, about basically 1 to 3, 1 to 4, and the reason why taking the options, and especially short expiry options, because I took the weekly option. The options are going to be, when I took the options, I took them on Tuesday night, and these options are meant to expire on Friday. So the problem with these options is that they have a theta. Generally speaking, the theta is the time decay that the option has, because the options is a finite instrument. it has a finite life, in the sense that it will expire at some stage, and in that case they will expire 3 days later. So there's a time decay, and the premium basically decays very quickly, because obviously these options will expire in 3 days. But at the same time, because they're very short options, if you take like the strike price, which is not too far from the spot price, the market will react very quickly. You've got like basically a lot of leverage that's basically built into these sort of options premium. I went long the the 4th of February 22 expiry, 65 put. So again, let me just show you again. This was the 65 puts. The market was there on Tuesday around 68.5, and I was basically looking for a put which was about 5% below. So nothing, nothing crazy, but if the market came out with a result that was not as good as expected, that's sort of like movement that you could expect, especially when the market is already in the downtrend. And what happened is that the market basically came up with results that were not as good as expected. As a matter of fact, a lot worse than expected. The market basically plunged all the way to 64, as you can see here. That was it held exactly almost to the cent. Let me just see what was the low on that day. 64.01. I mean, the level was 64.02. See, what I'm telling you, prepare your levels. Have be ready for intervening, on your levels. That's very important. That's part of your job. That's part of the work, of the pre-work that we do, on the stocks, on anything that we trade. So the market basically opened with a gap down of about a little less than 4%, then kept on basically diving, and then found like a big bounce off the 64 level. That was the level that I was eyeing. I mean, that's why I took these 65 puts, because I think like when I looked at the 64 puts, either they were not quoting, or the volume was not important, or so when you're going to trade in options, you want to have like an open interest. That means that basically that's the open position that's in that contract. That's quite important, and a decent volume, because then that means that you'll get the liquidity, you'll get the players that will react on that one. So that was the reason why I picked up that particular premium. And so that's the blue candle here on Interactive Brokers, so you recognize it. I bought the premium at 51 cents on Tuesday night. Again, knowing full well that I'm going to have a pretty quick decay on the premium if nothing happens. I mean, this thing had to react right after the earnings report, or at worst the day after. But more than that, and then the options would have quickly died. So for me, my in that case, my downside was the full option premium. So you know what, if you remember, and I'll show you that. Oh, I'm trying to bring the calculator, but a premium of 0.51, okay, and you have to multiply that by 100 shares, which represent the contract of options. That's $51. That's what you will spend for that option. Again, if you were basically to take, say, even on an account of 50,000, then taking basically 0.5%, that would basically tell you I can take $250 risk per trade. Again, still quite conservative, and that means that in that case you could have bought basically 5 contracts. Okay, forget about the number of contracts that are traded. It has no relevance whatsoever. And earnings came out bad, and immediately, as you can see, it's just 5 minutes bar chart. So the market very quickly went, like I was showing you on the daily chart of the stock itself, the underlying stock, went all the way down to 64. That was my cue. This is basically what I was eyeing for. And usually in this trade, I don't I don't screw around in the sense that, I know exactly why I took that trade. I know exactly what the rationale of my trade was. I know exactly why I'm supposed to basically come out, and I'm just going to basically I'm going to be quick. And I tell you what, I've done this mistake again. In my younger days, I was doing that mistake. Even doing the options, it's even worse in the options. Like I said, trying to take that home run trade and to really basically hold on onto it and thinking, hey, the market's gonna go higher and higher. I can feel it. I can smell it. And at the end of the day, basically, you end up giving back everything that you've made, or sometimes even lose money out of a green trade. Again, that's the whole idea of the trade management. Not avoiding to have a green trade turning into a red trade. That's a no-no really for professional traders. The rationale was to play a downward convergence trade just before an earnings report, which I felt, if it's not good, and knowing a little bit of the story of Gilead, there might be a chance that it would not be good. And the risk reward is great. Worst case scenario, I'm gonna lose the whole premium of that, and that's what I was ready to basically lose, $50 per contract. And best case scenario, it would go to that sort of area, 65, 64, and then I would basically be able to cash in on that. I got out when the spot was trading 64 or very close to 64. I TP1, but I kind of took my whole position out at $1.22, 150% risk return on investment. That's the magic of options. And the other magic of options is that, what, if I basically took that trade on the options, and let's say that the earnings report have been good, and the market basically went all the other way around. I mean, instead of basically going all the way to 64 from where it was around 60, 68 and a half, let's say that the market had gone to all the way up to 70, 71, 72, whatever it is. If you're short, and especially when I have a big gap up and you can't do anything, you're exposed. So, you might have a certain assessment, and I'm going to go back to the chart. Let's say they know that my assessment is that I want to stop out if the market goes above $70. That's great. I mean, then you can assess that the way that where you want to get out. Then on the back of basically that, you can calculate obviously the position that you want to take. But again, if the earning that come the other way around, and there's a big gap up, and it basically the price gaps above 17.5 and starts trading up like crazy, then you have a massive slippage on your stop. You're going to lose a lot more that you expected to lose. Whereas the thing with the options is that you paid your premium, and you've noticed that most of the options trade I will talk about are long premium. I'm long the premium. Okay, I'm long volatility. I'm long premium. So yes, the time decay is working in my disfavor. Yes, the volatility, if it basically gets crushed because there's no volatility and the market doesn't do anything, works in my disfavor. But at the same time, I'm not short premium. Being short premium is a very dangerous game, and you have to basically understand that. And there's a lot of people that are playing that, and usually, they they end up losing a lot. And a lot of people, they don't understand what it really means to be short premium. Being short in general, you've heard me saying many times, being short, you have to be extremely disciplined. You have to be extremely on top of your risk management, and you can't mess around with that. You have to basically be quickly reactive on according to your risk. But when you have, again, the earnings report, it can be a bit of a gamble. Definitely a bit of a casino play. But when you play with the options, you know exactly how much you stand to lose. That's if you stand to lose the full premium that you paid, which in that case was $51 per contract, then that's what you stand to lose. Depending on basically what's your, like I said, if you were to take a risk management of 0.5% out of a $50,000 equity account, then that means that you could play 5 contracts And those 5 contracts, will cost you $250, about $255. And that's it. And that's all you stand to lose on the options, no matter what happens to the earnings report. Long 51 cents, sold for 122 cents, 150% return on investment. That's the power of options. And definitely, the leverage power of options, the big advantage of knowing exactly how much you stand to lose if you lose, all of it. And again, I could have basically, if it had turned against me, if it turned basically against me, even on that option trade, maybe I could have basically salvaged the options for 20 cents. So I will lose only basically half of the overall amount of money that I was ready to lose at the beginning. So you can still trade the option out, before, not waiting that they're worth nothing. And finally, before I let you go, I will show you the last trade, and this has been just, just amazing. I mean, this has been like and I will tell you very frankly, guys, I've been extremely lucky on that one. But it's a matter, it's first you need luck as well, a little bit in trading, like in anything else. But also you need to understand that out of all the companies that I've been reporting, there's some companies that definitely will get a lot more volume, a lot more action, a lot more drama. And the fact is that Facebook has been on the playbook of many analysts. A lot of the traffic that go through website originally comes from mobile devices these days. I would say that probably a good 70 to 80% of the traffic originally comes from mobile, and a lot of this mobile device comes from iPhones, because there's, I don't know what's the overall market share from Apple these days, but definitely even on my own website, I can tell you that I get like a good 50%, if not maybe sometimes 60% of mobile devices that are iPhones. When Apple basically came up with the new iOS version, and they rolled out the new version, people were being given the opportunity to tick a box saying, I don't want to share the data anymore. I want basically to keep all my data secret. And this data was basically what makes all these companies, especially Facebook, which was also having a lot of data and very focused data on the consumer, and that's what was helping a lot of the digital advertisers. Now they can't basically get access to the data the way that they used to, and that means that basically digital advertisers using Facebook won't be able to be as laser focused as they used to be before. And this was my game plan. I mean, again, nothing to do, having a crystal ball and thinking that Facebook is going to come with awful uh, quarterly reports, but that was a sort of game plan. The game plan was, again, looking at the chart. We've been coming up from the all-time high in Facebook. Now, on when we closed already, in fact, the recent basically low that we established, before the big bounce on the Friday last week, the market had come down 25% on Facebook. We had that massive bounce that we've discussed at the beginning of the session today, and we're coming in right in the middle of basically my big area of resistance, the downtrend conversions, made up by multiple basically horizontal support, EMA 15 100. I mean, this area of like around 326, 327, for me, that was an area of where it made sense to be short. And not only it made sense to be short, but before the earnings report, again, trying to contain your risk by playing the options market and trying to find some like cheaper options that you can get out there, knowing that the sort of like level where I thought, I couldn't see that market really going much higher than say 339, 340. That was kind of like the level at which I would have basically started liquidating the short position via the options that I had bought. But that was the same sort of idea, again, expecting some kind of surprise or something that not as good as expected from the market, from the earnings report, coming in at a place where it made a lot more sense to be short Facebook, and having a risk reward of basically, again, right now being 326, having maybe $10 of downside, but at the same time, being able to go all the way down to 290. That means having almost $36 of upside. So $10 downside, $36 upside. For me, it's a good trade. It's a good trade to take. Okay, but I was not. For me, again, taking that trade around that, aiming at having basically the market, reacting badly, aiming for that sort of like level of support, 290. That was the idea for me. The market basically opened during the night right after the earnings report. The market basically just collapsed, and on the open, kept on basically going down. And turning back to the options trade that I took, what am I looking at that? So the options that I found on that play, again, same sort of thing. I bought the weekly options, the 290 puts. So like I said, let me show you again. Level was basically that I was eyeing was 290. I was expecting that basically, if the market is going to correct on the buy the earning report, and we have like, this massive asymmetrical opportunity, then it will basically find support here. And therefore, buying out of the money option, put options, 290 strike was making a lot of sense. This put was costing $2.50, so $250. Again, more expensive than the previous two premium on the two previous options trade. But again, depending on your size of account, still manageable. I mean, if you want to take one contract, it's going to cost you 250, and that's the worst case scenario that you can lose on that trade. $250. That's it. But the thing is, like, the market opened with a gap down on the stock of 21 or 22%, which basically, again, is like, it's not the sort of event that you find all the time. The last time that it happened was, again, June or July 2018, that we had that in Facebook, where the market basically opened with a 20% gap. But it goes to show you that even on companies like Facebook, this thing happened. The overnight gap risk is very, very much present. Even if you have like people telling you, oh no, but it's Facebook, oh it's whatever, JP Morgan, no, there's no such thing. You never basically can be covered against a credit risk in the sense of having a bad earnings report or some kind of news that we didn't expect, from Zuckerberg, whatever it is. So when this sort of thing happens, then that gives you this sort of crazy trade that I did not expect at all. You don't play around. You just basically don't play. I mean, anyway, that was the idea. That was a rational trade. I was kind of expecting something that would be a little bit worse than what the market expect, and thinking that we're going to start seeing the effect of this iOS rollover. And for me, the trade was offering a perfect timing in terms of basically area of resistance that we'd hit on Facebook on the stock. I was not honestly thinking that the stock would gap down 20%. I was far from thinking that, but again, sometimes you're lucky. And you know what? This sort of trade, I mean, we're talking about like 1,700% return on investment, that one. This is not a typical trade that you will get on the options. As a matter of fact, it's very atypical. I mean, you can get this sort of like return on investment on options trades if you carry the trade if you have like first options that expire maybe in a month's time or maybe a bit more, but you get a little bit of time ahead of you, and the time decay is going to be less than on these short term options. And if you want to carry, that's sort of like a trade on as a sort of like medium swing trade for 2, 3, 5 days maybe, and then yes, you can achieve this sort of return on investment. But when I'm talking about like in less than 10 hours, this sort of that's you don't get this sort of return. It's not the usual. The more usual is basically the sort of like returns like here that you get like 140%, 150%, maybe 300%. That sort of return that you can get on the option when you get the timing right, when you get the entry right. Here it's like it's like almost like a Christmas gift, but again, sometimes it works out way beyond expectations.
So you see the fact that still going into a situation which is very unknown, like the earnings report, being a kind of like very much flip of a coin situation, we can still find some pretty decent trades that offer great risk-reward ratio. And because we get into these areas where we get asymmetrical risk, and that's the sort of trades that you really want to take. Having basically understood that you've got this little bit of risk that you can put on that trade, but at the same time you get 2, 3, or 4, 5 times the reward waiting for you. And sometimes like in the case of Facebook, like in the case of UPS, where we've had like really earning surprises, then the trade can go fantastically well, even using a small account for that. You will be exposed to risk, but then again, this risk will be managed the way that it should be managed. This is the most important thing. This is the only thing that you can measure is your risk. This is the only thing that you can do for your own sake is protect your capital. But this sort of like situation, asymmetrical trades, they give you these best trading opportunities. And I hope that you really enjoyed the video. I hope that basically, if you want to see some more of these videos, I'm going to start posting more regularly on YouTube. I'm going to start posting either from my TradingView account or YouTube, and I will start posting like maybe once or twice a week. If you want to basically get involved, just hit that subscribe button and you basically get a notification. If you like the content, or if you'd like to basically see get more details on something that I've touched upon on this video, just basically make comments and let me know something that you want me to talk to you about. I think I'd like to take this YouTube channel more around a thematic channel where we're going to basically cover some interesting concepts of trading, essential concepts of trading that you can incorporate in your trading and make it really something useful for you. And also, looking at the market analysis, looking at some trades basically unfolding, losing trade, winning trades, but trying to make you understand that there's always a rationale. There's always a reason for taking a trade. It has to. And this reason is basically behind this game plan that you have. If you don't have a game plan, then you don't have anything really. The market is already very difficult enough to handle, and if you basically don't have a plan before you even start thinking getting in, then I would really say to you, just stay on the side, watch a lot of videos, or paper trade for a while, but you need to basically have that process, that thought process that comes to your mind as to why you need to enter, when you need to enter, how much you need to risk, and how you're going to basically exit that trade. These are basically the 4 main fundamentals, most important points that will come in your trading. Okay, I hope you like it, and I will see you very soon.